All right, so you're thinking about buying a home here in Kentucky. Fantastic. You've probably been checking your credit score on your phone, right? Well, what if I told you that the score you see isn't the one that actually matters for a mortgage? In this explainer, we're going to pull back the curtain on the whole process, starting with that one huge myth. Okay, let's get right into it. So you pop open Credit Karma or another free app, you see a number, and you think, okay, I'm in good shape. But is that really the number a mortgage lender is going to use to decide your future? Honestly, the answer is a hard no, and it catches so many people by surprise. And here's why. This is the big disconnect. The score on your app is almost always a Vantage score. It's great for just keeping a general eye on things, but it is not what a mortgage lender looks at. When you apply for a home loan, they pull a very specific and kind of old school set of FICO scores. Hey, don't just take it from me. Listen to Kentucky mortgage expert Joel Lobb, who puts it plainly. Your Credit Karma score just won't cut it. And we're not talking about a small difference here. The gap between your Vantage score and your mortgage FICO scores can easily be 10, 20, sometimes even 50 points or more. That's a huge deal that can totally change your interest rate, or even your approval. So what is this, secret recipe the lenders are using? Well, they rely on these older, much more conservative FICO models. Think of it like a classic family recipe that hasn't changed in years. Because they're more old school, they're way more sensitive to things like opening new credit cards, having any accounts and collections, or even just having a lot of recent credit inquiries. Now, it's not based on just one single number. A lender is going to pull a full report from each of the three major credit bureaus. That's Experian, TransUnion, and Equifax. And here's the crazy part. They use a different specific FICO model for each one. Let's break down exactly what they're looking for. Here they are. These are the three models that matter, period. For Experian, they're pulling FICO Score 2. For TransUnion, it's FICO Score 4. And for Equifax, it's FICO Score 5. Memorize these because they are the only ones that count when you're getting a home loan. Okay, this next part is absolutely crucial. Once the lender has all three of those scores, what do? You'd think they just average them together, right? Nope. They actually throw out your highest score, throw out your lowest score, and the one left in the middle? That is the magic number. Your entire mortgage application hinges on that middle score. So let's talk about the key numbers you need to know in this game. The first big one is 620. You can think of this as the dividing line. If your middle FICO score drops below 620, you've officially entered what lenders call subprime territory, and that makes getting approved for a loan incredibly tough. Now, on the flip side, the goal you're really aiming for is 760. This is the score that unlocks the absolute best top-tier interest rates. And believe me, this matters. Every notch your score drops below this, your interest rate creeps up, and that can cost you thousands upon thousands of dollars over the life of your loan. Okay, so how do those scores plug into the actual loan options here in Kentucky? Let's look at the playbook. If you've got a few credit bumps or not a lot for a down payment, the FHA loan is an amazing starting point. You can get in with a score as low as 580 and just 3.5% down. For our veterans or for folks buying in a qualifying rural area, VA and USDA loans are incredible, 0% down payment. And then for borrowers with stronger credit, the conventional loan is the way to go. But you'll want that 760 plus score to get those sweet low rates. And I've got to tell you about this awesome tool just for Kentucky buyers, the Kentucky Housing Corporation, or KHC. It offers down payment assistance, and listen to this. Right now, there's a temporary boost up to $12,500. The best part is you can stack this help on top of any of those major loan types we just talked about, as long as your middle FICO's at least a 620 and you meet a few other rules. So you know what the lenders want to see. Now, how do you actually improve your score? Well, you have to know what it's made of. There are 5 key ingredients. But look, the 2 biggest chunks are payment history at 35% and amounts owed at 30%. That's 65% of your score right there. If you can master those 2, you are well on your way. So here it is, your 3-step action plan. Step 1. About 6 months before you even think about applying for a loan, go to annualcreditreport.com. It's the official free site, and pull your reports. Comb through them for any errors. Step 2. Get aggressive with paying down your credit card debt. Your goal should be to get every card balance under 10% of its credit limit. And step 3, this is a big one a lot of people mess up. Do not close your old credit cards. Keeping those old accounts open is great for the length of credit history part of your score. It also really helps to have a realistic timeline in mind. Most of the bad stuff, like late payments or collections, they'll stick around on your report for 7 years. a personal bankruptcy, that's going to be on there for 10 years. Just knowing this helps you plan and set your expectations for the long haul. Look, at the end of the day, getting a mortgage isn't some big, scary, unknowable secret. It's a system. It's a game with a very clear set of rules. And now that you know which scores really matter, what loan programs you can use, and how to get your finances in shape, you're not playing in the dark anymore. You've got the playbook. We've just gone from that feeling of confusion, staring at a score on an app, to having real confidence, because you know exactly what Kentucky mortgage lenders are looking for. You know the rules. You've got a game plan. So the only real question left is, what's your next move?